Nuclear has a really bad reputation. I call this the Blinky effect. You'll recall the three-eyed fish from the Simpsons nuclear power plant. Historically, there have been safety incidents, Chernobyl, Fukushima, and then there's the ongoing issue of waste disposal. Upfront construction costs are also an issue, with projects such as Hinkley Point in the UK continually plagued by cost and time blowouts. And then there's political sensitivity, of course. We would know nothing about that in this country. Despite all of this, there is significant opportunity. We're already starting to see that play out in global listed infrastructure. I have more to say about this later. I'm Sarah Lau, one of the 3 portfolio managers for the Global Listed Infrastructure Strategy at Resolution Capital. Resolution Capital is a listed real asset specialist. We're very proud of our consistent long-term investment track record, and we fundamentally have one investment philosophy across all assets, and that is we're looking for high-quality assets, capable management teams with skin in the game, and of course, sensible capital allocation. Now, back to nuclear. 20 countries have committed to tripling their nuclear capacity by 2050. Morgan Stanley estimates that this is an opportunity worth $1.5 trillion US. This isn't the same nuclear that you're seeing or you have seen on a hit TV show. Nuclear has changed. Firstly, the safety. The new generation 3 reactors have improved containment and they rely on natural processes like gravity for safety. And there's a simpler design. What this means is that the generation 3 reactors don't melt down. They just cannot. And then there's waste. You're seeing countries now such as France, Finland, and Sweden start to implement new disposal systems which are deeper and more secure. I want to unpack the economics or construction cost side of things a little. This chart here is a timeline of when the US nuclear power plants came into service. And you can see that most of them were constructed during the 70s and 80s. Interestingly, this fleet of roughly 100 plants are all like snowflakes. There's 50 different designs across this fleet of 100. This technology has never scaled. Now, I'm going to talk a little bit about the 2 units here that came into service last in 2023 and 2024. They were built by a company called Southern Company. These 2 units were Vogtle units 3 and 4. Combined, they power about 1.5 million households. The initial cost estimate was $15 billion US. During this construction process, Westinghouse, who manufactures the reactor, went bankrupt. And then they went through COVID. So what happened was that the cost ended up being $32 billion US, and the whole process took 10 years, which was roughly double the initial estimate. Now, the US Department of Energy points out that this is really a first-of-a-kind project for a Generation 3 reactor. Theoretically, if you just cookie-cutter manufacture these from now on, you should lead to efficiencies and therefore lower costs and quicker build time. Now, nuclear is relevant because it could solve some critical issues of the economy today. Electricity demand is one such issue. For the past 2 decades, we've really seen no electricity demand growth. Population growth and new applications in the US were really offset by efficiencies like LED lights. Now, as we moved into the 2020s, we've seen data centers and advanced manufacturing start to consume more power, and AI would demand even more. Every single search that you do on ChatGPT takes 10 times the amount of power that Google search takes. DeepSeek was commented on earlier today, and I'm going to add my 2 cents. It really hasn't changed our overall view on the trajectory of power demand in the US. We're still in the very early stages of AI. Now, if the cost reduction is real, you'll see that rollout broaden out just from the very select few of Google and Microsoft into maybe a Salesforce or the second tier of tech. And if it cheapens more, you'll see the rollout even broaden more. So what does that mean for electricity demand? We're still very, very confident that it will grow a lot from here. There's likely to be some changes to these locations of where the electricity demand is, but the overall picture doesn't change. Now, electricity demand or power demand is important because this really means that there's more infrastructure needed. And this growth, this need, layers on top of an already investment super cycle that's occurring because of energy transition. Growth is accelerating for electric utilities. Nuclear is a unique opportunity. It's perfectly suited for AI. If you consider that most tech companies, including the hyperscalers, have decarbonisation goals that they haven't stepped away from. Let's have a look at the different technologies that are available for generating green power. You can see in the blue line here, solar has a very specific and defined peak during the middle of the day when the sun is out. Wind in the red here varies through the day depending on the weather, clearly. Nuclear in the dark blue matches the demand profile of a data centre almost perfectly. This is really an opportunity for existing owners of nuclear. In order to have new nuclear by early to mid-2030s, you need to get started now. Existing sites have a significant head start because, existing plants, because they have the sites ready for additional units. And where nuclear is already operating, those communities have some of the highest support for nuclear because they are very important employers to those communities. So there's a lot less likelihood of opposition. And this opportunity is very relevant for listed infrastructure. 65% of existing nuclear power plants are owned by listed US utilities. The upshot here is that Blinky is not real. This is an opportunity. I want to share 3 high conviction portfolio holdings with you. Southern Company. I mentioned earlier that they went through the very painful experience of building Vogtle units 3 and 4. It was write down after write down. Now this company is a monopoly electric utility based in Georgia, Alabama, and Mississippi. Along with the rest of the market, we thought that after the construction of Vogtle, Southern will go back to being a boring electric utility that provides predictable returns. Our property team keeps a really close eye on the data centre market, and what we gathered from them can be summarised in this chart. The data centre demand and the forecast of supply of inventory of data centres in Atlanta is exploding. This means that even though Vogtle was put into service, there is more need for electricity infrastructure, such as more generation, more poles and wires. Now, as the monopoly utility, Southern is allowed to earn a reasonable rate of return for such investments, which we think will lead to higher earnings for a longer period of time than the market's realising. Constellation Energy. This company owns a quarter of the nuclear fleet in the US. When this stock was initially spun out, it didn't meet our investment criteria. It was exposed to commodity power prices. Then the US government came in and realised that the strategic value of 24/7 emissions-free power was worthwhile of underwriting. So this means that today the cash flows of this company are now defensive and inflation-linked. We started buying the stock at $80 and now it's the latest price is over $300. Constellation Energy is able to contract at prices above that US government guarantee and above market prices, actually. This picture here is of 3 Mile Island. One of these units were shut back in 2020 when power prices were very low and before that US government underwriting came in. Last September, Microsoft came in and entered in a contract with Constellation to purchase power off them for 20 years for restarting this unit. I calculate roughly a 25% internal rate of return for the duration of this 20-year contract. And then at the end of this contract, Constellation actually has a plant that will continue to operate for years after that. This company also has strong balance sheet and cash flows to realise the optionality of their sites and also do buybacks and bolt-on acquisitions. Another stock that we like is Kinder Morgan. It is a natural gas pipeline network company in the US. It's a bit like the APA on the ASX, really. We see better growth and a slightly better valuation from Kinder Morgan. Natural gas demand in the US is going to increase by roughly 20% over the next 5 years from applications such as LNG exports and coal to gas switching for electricity generation. You could see here that this network of Kinder Morgans is very attractive. It's perfectly very dense around the Gulf Coast where the LNG exports are, and it's got really good exposure in the south where a lot of the industrial manufacturing is landing. So this company actually had quite tepid earnings growth for the last 10 years because they had a whole lot of legacy contracts that were rolling off. That is now done. What we're seeing now is that this network can capture the growth going forward. When we caught up with Kimberly Dang, the CEO, in September, she was beside herself in excitement. The new project returns today are higher than they were, and also this company's balance sheet is perfectly poised to take advantage of those opportunities. Nuclear and our position on it is one example of how we think and invest at Resolution Capital globally listed infrastructure. Our universe has long-term growth thematics, and we look for underlying assets with outsized capture of these. This is a snapshot of some of these growth tailwinds across our portfolio, and they include energy transition, energy security, and mobility. These growth tailwinds are not captured by the current market valuations. This is a chart of enterprise value to earnings across the global listed infrastructure sector. And you can see that valuations are by no means stretched, but we do see growth accelerating. Moreover, transactions in the unlisted or direct market continually happen at premiums. So in other words, you can access high quality infrastructure which is growing above inflation for cheaper prices on the listed market. Our fund is deliberately designed for clients looking to have exposure in a defensive growth asset class that's ideal for compounding wealth. Adding real assets like infrastructure and property enhances diversification and provides an inflation hedge. Resolution Capital's broad real assets focus gives us unique insights and an ability to see through the noise like the blinky effect. This has enabled us to deliver strong results for clients thus far. Now, everything we do at Resolution Capital is client focused. One of the reasons why we run a multi-portfolio manager model is such so that clients don't have key person risk. We're also incredibly excited to be listing our global listed infrastructure strategy on the ASX for your convenience under the ticker RGIF. And that will happen in late March. Thank you.